Hello, everyone. Our guest today is Raj De Datta. He has brought 10 years of enterprise and entrepreneurial experience with him when he co-founded his current company, Bloomreach. Before launching the company, he was entrepreneur in residence at Mohr-Davidow Ventures. Prior to that, he served as Cisco's director of product marketing and was on the founding team of telecom company FirstMark, LambdaNet, which grew to 80 million in run rate, in ARR, I presume. He also worked in technology investment banking at Lazard Freres. He holds a Bachelor of Science in Electrical Engineering from Princeton University and an MBA from Harvard Business School. His thoughts on navigating the challenges of high-growth startups can be found on his blog at ddatta.com. That's DEDATTA.com. Raj, are you ready to take us to the top?
I am, absolutely.
All right, tell us more about Bloomreach. What's the company do and how do you make money?
Absolutely. So what Bloomreach is we're in the business of offering a platform to power digital experiences. So think of every interaction you have online. You go out, you buy a pair of shoes, you look for a date, you're organizing a movie. All of those experiences online can be pretty painful. And the start of the company was really asking the question, why couldn't every experience on the web feel the way it does at Netflix or at Amazon or at Uber or some of the sort of much more modern tech companies out there? When we think of enterprise brands, the banks and the airlines and the insurance companies and all of the other big businesses we interact with in the world, their digital experiences feel nothing like Netflix and Google and the like. So we came about trying to say, let's create a great digital platform that makes it possible for every enterprise in the world to build an amazing digital experience. And let's offer that platform to everybody. Let's get 7 billion people around the world to have an amazing digital experience. That's why we started the company. And fast forward now several years later, we make money in a SaaS-based business model. So we offer our services in the form of a subscription. And large enterprises sign up and we drive their digital presences.
And are we talking, give me a sense here of generally on average in a year, they're paying 10 grand, 100 grand, a million, 10 million. What's general size?
Yeah, average ASP for us is around 250K per year. We've got several clients that pay us more than $1 million a year. Yep. So it's an enterprise type business.
And what pricing levers do you use to drive expansion ARPU? Is it number of site locations like a Neiman Marcus or what are those utility metrics?
Yeah, so there's a bunch of ways by which we grow. We grow because people, when they launch digital properties, websites, and apps, they'll often do it in many countries. So they'll have different properties. They will own many brands. You mentioned Neiman Marcus. Neiman Marcus owns a selection of brands beyond Neiman. Williams-Sonoma, another one of our clients, also owns Pottery Barn Kids. So they'll have multiple brands. And they'll pay us more, when that's the case. And then we'll charge them more as their page views grow and as their traffic grows. Then they'll use more of the platform. And finally, they buy more products from us. That's when they buy more products, then that's an expansion in the amount that we charge.
So number of languages, site impressions, and just pure additional product upsells.
Additional products, that's right.
Interesting. Okay, give me more of the backstory here. So when did you launch the company?
Yeah, so started working on the company in 2009, and it was a small team of us, myself, my co-founder Ashu, who had built a lot of the search engine at Google, and we pulled a team of people mostly out of Google. It was a group of 5 or 6 of us, and the original pitch was, if we can build a platform that you can plug any website or app into, and it's going to immediately generate highly relevant experiences for consumers, wouldn't that improve the consumer experience and drive more revenue for whoever's publishing the website or app? And if we could build that platform, it would serve everybody. So we spent about a year and a half kind of in R&D, built a machine learning system around that basic problem, proved that it could work by kind of 2010, started to approach a set of clients, and really only launched the company publicly in 2012, or maybe it was end of 2011. And that was when we sort of began to take it to market.
And how did you support yourself in those first 2-3 years? You guys just had savings from Cisco and Google that you lived off of, or what?
Yeah, so we definitely did that for a period of time. Eventually, we had our first investor, Ajay Agarwal, who's a partner at Bain Capital Ventures. He put in the initial $5 million. And, kind of our pitch to him was pretty simple. It was sort of, if we build this platform, it's going to transform every website and app in the world. Wouldn't that be a great business? Yes. And so the risk here is really the technical risk of whether we can build a machine learning, self-learning system that could work for any website or app in the world. And so to mitigate the technical risk, we got to hire the 10 best engineers we know who are at places like Google and Facebook and recruit them in. And so he put in the original $5 million. We said we wouldn't really spend it. We'll just perfect the platform. And once it was up and running, then we'll start approaching clients for revenue.
So today, how much total have you raised?
So today we've raised $100 million.
Okay. So obviously significant capital raising after that I want people to make sure they pull the right lessons from this interview. I mean, one of the reasons you're able to get 5 million early on, obviously, is because of your guys' backgrounds, right? It's not as simple as just saying, look, here it is. It's going to be a success. Yeah. Boom. Right.
Yeah.
Yep.
That's so right. It was, I'm a third-time entrepreneur. I'd done this before. Ashu was a well-regarded machine learning kind of guru out there. So it was our backgrounds. And I think we had a crisp problem statement that was pretty different. Nowadays, the use of AI and machine learning is popular. In 2010, 2009, we were very early in saying we're going to have every website and app in the world powered by that. And so it was a distinct message and a distinct proposition of, hey, we'll do something pretty different with this class of technology, solve it in a different way with a different kind of team, and with a fairly clear business idea that we were going to go after enterprises in a SaaS-based pricing model. And so we were fairly clear what we wanted to kind of go about doing. And what's interesting so many years later is the mission of the company hasn't changed.
So what have you scaled to today in terms of total customers you're working with?
Yeah, so we work with about 250 large enterprises, and they have tens of brands each. So if you think about it in terms of websites or apps, it's probably 1,000 plus. If you think about it in terms of companies, it's probably 250.
The number you gave me early of the 250 grand ACV, though, that's really per company you're working with, right? Per 250 that you work with, or no, it's per website or something else?
Yeah, so that's an average per account, and you can think of the scale of the business as being between $50 and $100 million.
Yeah.
ARR.
I was just going to say, so if I take 250 times 250 grand a year, you're cranking somewhere, 5.2-ish, I think, per month that comes out to, or somewhere around 55, 60 million annually right now.
Yeah. And so when we have services revenue, that we charge for as well, because when people use our platform, they have to implement it and we support them through that. So you can think of our ARR or our total revenue as between 50 and 100.
Got it. Now, of the number that I just gave out, though, the basically 5 million a month, is that pure play SaaS, the 250, or did you include the professional services in the 250 ACV?
I did not include
the
professional services in the ACV.
And is one of the reasons, so tell me the correlation between how you think about professional services and what that's done to help you reduce your churn. I assume you're basically taking that money in to do onboarding and things.
That's right. We do a couple of things with professional services. We help with onboarding. We help with analytical services. So people use our services. How do they get more value out of the software once they've bought it? We'll do things like premium support services. So some of them are technical in nature. Some of them are business consulting in nature. We also have a very large partner community. So we'll do training of partners and certify them on our platform. All of that is services. And so
diving deep into some unit economics here for a second, what is your churn today, or how do you think about it?
Yeah. So we think of, gross churn for an enterprise business. We think best in class, you want to be at no more than, say, 10 to 12% gross churn, and we are in that range. And then you want to be pretty close to 0% net churn or negative net churn, and we are there as well because we have a healthy upsell business.
Just to be clear, that's that range you gave. That's 10 to 12% gross revenue churn annually, and negative churn obviously annually as well for net.
Yes.
Yep. The ones that do churn, why do they churn?
Yeah, I think it happens for a variety of reasons. You might have mergers and acquisitions, and companies may get folded in. Some of them might go out of business. Some of the smaller businesses will go out of business. Some of them will use the platform and decide, they have a change of strategy. They want to build some of the software. Others might, a selection of them will go to competitors. At the scale that we're operating at now, where we're driving, the number of accounts and the number of deals that we're doing, it could be for a variety of reasons. But what's interesting in our space is I think we are very much a challenger in an $8 billion market that is dominated by people like Adobe that have a $1.2 billion software revenue stream in our market.
Yep.
So from the market's perspective, we're sort of the fast growth challenger with a net new platform that's open and has, machine learning and intelligence built in. It's much more cloud, it's much more subscription. All the sort of new software models that we in Silicon Valley take for granted is still not the predominant model in the industry.
Would you sell to Adobe for $400 million if they offered it?
Well, I think it's fair to say that we've received very healthy acquisition offers, at or around that range, and turned them down.
Yeah. And walk me through, as an entrepreneur, how do you manage that risk? I'll never forget the mistake I made at my first company, where I turned down an acquisition offer that would have changed my life. But I'm like, you know what? I read that Mark turned down Yahoo for $1 billion. And you know what? My dick's big too. So I'm going to say no. Right. And it was a huge mistake. So how do you manage, when do you take your wins and move on to the next big thing?
Yeah, there's no right answer to that question. One, it's a very personal question. Each individual, I think, is in a very different spot in their life. And so one, I think you got to ask yourself, you got to not be doing it for ego. You got to be doing it because it's what you really want in your life. No one will reward you for making a bad decision later, but just because you made a decision to satisfy your ego at the time. So know yourself would be the first thing I would say. The second thing is know your opportunity and be real about it. I think every time you turn down one of these things, the moment that I've talked to every entrepreneur about is you have that oh shit moment after you say no, where something bad happens and you're like, man, I should have taken that deal, right? And you got to know that's coming. So
it will happen. Yeah,
it will happen. You got to know the risks as you do it. And then, of course, it's about the rest of your shareholders, ecosystem, customers, employees. I believe in the promises that we make, both to our investors, our employees, our customers. So I take those things pretty seriously. It's not just about the money.
Last few economics questions here before we wrap up with the famous five. So at 12% gross revenue churn, what do you assume a minimum is? A maximum can get dangerous because you're doing so well at churn, but what do you assume a minimum is in terms of lifetime value on these accounts once you get them in?
I think in our kind of business, these accounts are with us for a minimum of, 5 to 7 years. Yeah. So, that's kind of that's a good minimum. Many are I expect longer than that. But yeah, so if you think about lifetime value calculations off of churn, they're very healthy lifetime value calculations.
Yeah, if 5 years at $250 a year, and I assume that's probably that ACV is expanding actually year over year, but minimum that's 1.2, right?
That's right.
Yeah. How does that help influence what you're willing to spend on CAC?
Yeah, I believe that CAC is about a few things. First, you can look at the lifetime value economics early in a company's life cycle. The reality is you actually don't know the lifetime value of your customers. They just haven't been with you long enough. So you can divide by churn and the Excel works, but you don't really know how long they're with you. And I think we're still early. So yes, I look at lifetime value as a ratio of CAC, but I also just simply look at risk. So if you where we are today, we tend to spend sales and marketing at a ratio of about a 1 CAC ratio. Right, a 1-year payback period, basically, and that to me seems healthy for where we're at.
So just to be clear, you would if your first year ACV is $250, you're okay spending that first year ACV on acquisition, so $250.
I'm okay spending a first year ACV because I know at a minimum I've got 5 to 7 years on the back end. We've got a high gross margin business,
plus expansion revenue,
et cetera. Right, so it makes sense. Now, arguably, one could be more aggressive than that.
Yep.
As well. And I think there it's about risk. It's about saying, well, stuff might change downstream. All kinds of market factors affect your business. You really can't predict for 5 to 7 years out with certainty at this scale of a business. So you need to think about the risk associated with that. And we have gone back and forth between kind of, I would say, 8 and 9 month payback periods and as long as 15-month payback periods. And it's sort of gyrated through the life.
Just depending on cohorts.
Totally.
Yeah. What's your team size today?
About 250 people.
All in Mountain View?
No, we've got offices in Mountain View, Dallas, a small office in Boston, London, Amsterdam, and Bangalore. Interesting. And last question: year-over-year growth. What are you targeting? What are you at? Yeah, I think that the without talking about today's growth rate, I think that the intention for the company is to get to a point where the company, when it crosses $100 million, it's a profitable company growing at 40 to 50% year over year, and we're on track for that.
Okay, good. Can you give me a sense over the past 12 months? Have you doubled, tripled year over year, or?
Year over year has grown really nicely.
Okay. Is that more than 2 or 3x? What's really nice for you?
It's grown really nicely without getting into the specific numbers.
So just to be clear, my audience might not know what really nice means, but that's something you don't want to dive into.
Yeah, I'm not into diving into the specific growth rates or the exact revenue numbers. I think it's between 50 to 100. We're on track.
Oh, that's great. Good. So over the past 12 months, you've grown between 50 and 100%.
The revenue is between 50 to $100 million.
Got it.
And the expectation is that as we approach $100 million, it will grow between 40 and 50%, and it will be profitable. And that's within sight.
Yeah. Because of how large numbers work, it's fair to say you have to be growing faster than that, though, currently, right? And as you get bigger, you'll settle into 40 to 50.
You have to manage both the growth and the profitability to achieve those targets.
Yeah.
Because if you're growing really fast and burning really fast, you don't hit the profitability target. And if you're, on the other hand, growing too slowly, you don't hit the growth target. So the art is in balancing both of those.
It's certainly a dance. Let's wrap up here, Raj, with the famous five. Number one, what's the last business book you read?
Well, actually, let me just say the last book that I read that I believe applies to business is The Giver which is kind of a children's book and is about a world without emotions and irrational behavior and what that looks like. And what that tells me, by the way, is there's a lot of things we like about our life that are irrational.
Number two, is there a CEO in Mountain View you're following or studying?
Well, the CEO that I admire the most is certainly Jeff Bezos. I think what he's done with Amazon is extraordinary, and a lot to learn from him.
Number three, besides your own, what's your favorite online tool for growing the business?
Yeah, I think my favorite online tool to grow the business is actually Salesforce. As much as I like all the cool MarTech stuff that we do, I think the single most important thing to get right is use of Salesforce at our scale.
Number four, how many hours of sleep are you getting every night?
I get about 7 to 8.
Okay, so that's healthy. And what's your situation? Married, single, you have kids?
I have 2 kids and I'm married.
Awesome. 2 kiddos. And how old are you, Raj?
I am 42.
42. Okay. Last question. What do you wish your 20-year-old self knew?
I wish my 20-year-old self knew to get into entrepreneurial undertakings even earlier. And I did it pretty early.
How old were you in the first company?
I was 26.
All right. Guys, there you have it. Raj, get in before you. If you're listening right now and you're past 26, you're too late. Start, go faster. At least that's what he wishes his 20-year-old self knew. Launched the company Bloomreach back in 2011, scaling nicely, raised their first $5 million. They're now helping over 250 really enterprise customers, paying on average $250,000 a year. Managed DXP, right? Digital experiences at scale. They've raised $100 million to date. Looking at settling in as they look to hit and break the $100 million mark, settling into 40-50% year-over-year growth rate, healthy growth rate today, currently doing between 50 and $100 million in revenue, 12%, again, gross revenue churn annually, between 10 and 12%, healthy economics with their team of 250 based across Mountain View, Dallas, Boston, London, and a few other locations. Raj, thank you for taking us to the top.
Awesome.